Thank you very much for staying. It's been a long but very, very interesting day. And we've got stuck with what I think is typically termed the graveyard shift. So we'll try and keep it as light as possible and get us... this is on, right? You can hear me, right? And get us off to networking drinks in good time. Oh, yeah, there we go. My name is McLellan. I'm the head of content for the Digital Monetary Institute at OMFIF, and today I've got this fantastic panel with me to discuss stablecoins and their potential use as global reserves. This is a topic that gave us all a little bit of some challenges when we were discussing it in our prep session. So I'm not sure we'll come up with a really definitive answer on how stablecoins might end up in global reserves yet. But Nick, I wonder if you could kick us off and just talk a little bit about, what are global reserves, where they're held, and if you see stablecoins potentially displacing that in the future.
Sure, yeah, happy to talk about that. My name is Nick Gersh. I'm Senior Regulatory Counsel over at Paxos. We do primarily stablecoin issuance. So, as was alluded to, when we were thinking about what this topic would cover, we were all kind of puzzling over what stablecoins' role would be as a global reserve. And I think where we landed is, at least when I think of a global reserve, I think of an actual reserve backing asset. And the reality is that in the short and medium term, stablecoins are probably not going to be in a position to be a global reserve asset anytime soon. I think what's much more likely is we will have things like tokenized treasury bills, tokenized money market funds, and other tokenized core reserve assets that then go into backing something like a stable coin. So I think if you look at like the hard definition of what global reserve means, we're not really at the point where stable coins are going to get there, I think, in the short or medium term. But that doesn't mean that stable coins can't still serve as a global reserve in other contexts, and I think that's where this panel discussions ultimately will end up going, and that means things like serving as a reserve for payment use cases, settlement use cases, and other related use cases that we more commonly think of stablecoins serving sort of right now, and I think we all anticipate really exploding over the next 2 or 3 years.
Yeah, I think that's a very good way of putting it. And I think, one of the things that we do at OMFIF is talk to a lot of central banks, and every year we do a survey of central banks on their reserve allocation, things like that. And we've started to throw in the question of if you consider holding digital assets, including stable coins, in their reserves, and it is... they don't. Almost unanimously, they're not yet at that stage. So it might come to fruition, but I don't think we're in a position where it's in the near future. But as Nick said, there are still a lot of uses where stablecoins have some unique qualities. Catarina, can we talk a little bit about the unique value stablecoins have in settlement?
For sure. For me, the key value proposition is that stablecoins being powered by borderless blockchain technology, they're a perfect fit for global economy. Essentially what we have today is payment systems that are regional and fragmented, and we made them work for a global economy by patching them with chains of correspondent banking relationships. And this is what makes cross-border payments expensive, slow, and also very opaque. Just to paint this picture in more concrete terms, for a EU-based company trying to pay a 5,000 euro invoice, the costs of paying that invoice if your supplier is outside of the SEPA region are something like 12 times higher than if your supplier is within the SEPA region, which then obviously then also ends up affecting SMEs in a disproportionate way. This increase in costs in cross-border payments for SMEs can be a deal breaker on whether you do business with a certain international counterpart or not. Holding that or having that correspondent banking relationship is expensive in itself. It requires respondent banks to pre-fund accounts with their correspondent institutions. This leads to trillions of dollars in tied capital, which could be put to better use by these businesses. So this carries a very big opportunity cost. And since today we learned that the world is obsessed with AML regulation for crypto, it's also worth pointing out that the fact that cross-border payments are today happening via these chains of cross-border relationship or of correspondent relationships also makes payments a lot more opaque, which goes directly against any objective of AML and CTF regulation. It's actually one of the big motivations behind the recent revision of Recommendation 16 by the FATF. It's the realization that payment chains are often in effect broken into several domestic small bits of information, which means that financial institutions end up not actually having access to identifying information about the end customers behind the transaction. And stablecoins, being borderless money, really removed the need for this complex web of correspondent relationships powering cross-border payments. Actually, as Commissioner Albuquerque alluded to before, stablecoins kind of make even the concept of a cross-border payment obsolete, right? It doesn't matter whether the payment is domestic or not. And so that carries a lot of advantages for international payments. It makes them cheaper, faster, a lot more transparent, which is great for businesses, but also for the regulatory objectives that we're working towards. I think this audience doesn't need a lot of convincing about the power of stablecoins as a settlement asset. I think a good question also for us to reflect on is what is between this potential or the realization that this is such an obvious product market fit, stablecoins for cross-border payments, and actually reaching the full potential of stablecoin adoption. I think today we capture something like 0.03% of the business payments market. Why is that? Why didn't we make a significant dent in that market yet? And some of that we believe is related to the workflows that we need to build around it for authorization, payment contexts, and so forth. And so stablecoins solve a big part of the payment system, which is moving funds, but there's a lot in a payment system that stablecoins alone can't solve. So we as an industry need to get behind that.
Yeah, and we'll come on to the policy environment that you alluded to as well a little bit later. But yeah, no, that was a fantastic description of the kind of unique qualities of stablecoin, and I think it's worth dwelling on the cost point that you mentioned for SMEs, because I think, you know, throughout payments there is always the trend of the lowest value payments, you know, done by those least able to bear the cost, or pay the highest proportion of the value of the payment in fees and other, all the associated costs. But let's just moving into sort of financial services. Dirk, I wonder if we can hear a little bit from you. You're part of a stablecoin consortium, and can you talk a little bit about where you guys see the value? I guess what use cases you feel like that stablecoin will meet for you guys?
Yeah. The first one is, of course, cross-border payments. Several of the banks in the consortium already are experimenting, doing proof of concepts, even live solutions on blockchain since 2016, 2017. Also ING, ourselves, we had trade finance platforms. Cross-border payment is one of the use cases. Of course, it can go faster. You don't have the correspondent bankings. Of course, for our customers, that would also be better. And you see it also in the figures. 95% of the stablecoin usage is still crypto trading, but the other 5% is growing fast. You have like an 80% yearly increase in other uses than crypto trading, being B2B payments, B2Peer payments, remittances, etc. So the use case is there. Stablecoin is a first implementation that is there already. For us as banks, it is a little bit counterintuitive because the funds that will go into stablecoins, we cannot use them to create credits on the market. Of course, we are fueling the economy with credits, and that's commercial bank money. And we don't have a mechanism yet for tokenized deposits for commercial bank tokens to move between banks, because therefore we need wholesale central bank digital currency, which we don't have. So as banks, you're confronted with, okay, we can wait, we can see what happens on the market, or we can go ourselves. And a second use case next to the cross-border payment is using payment rails on blockchain solutions, where we had we were part of several consortia where you had the issuing of a corporate bond and trading of a corporate bond, but there was no payment lag. So you need to go off the blockchain, do your payment, go back to the blockchain. There, reconciliation came in. The same we had with trade finance open account, and that's not even cross-border, that's within Europe. But from the moment that your business transaction is on blockchain, your invoice, your PO, and you have your settlement leg on blockchain, you can have an atomic operation. And that's also what you now see with digital assets that you can use with stablecoins. So there's a possibilities that are opening up. As more digital assets are coming on-chain, a stablecoin makes more and more sense. Also for companies, not only for doing a cross-border payment, but for treasury, for company treasury. If you have several accounts across the world, and you want to pool the money in euro. So these were all motivations for us as banks to come together to say, okay, we can all issue our own stablecoin. We did actually back in 2021. We still have it. This is on private blockchain, so it's not issued to the broad public. But if you're doing that alone, your network effect is smaller. So we were looking at, okay, we should have like a European standard. Let's pool together the forces of the banks, also the trust of the banks. Like we can do reserve management quite well, I would say. We're also under supervision of the ECB. So we are used to do this. Let's come together to issue a stablecoin to become a standard for all kinds of use cases that there are. Is demand already there? Yeah, the demand is growing, but at least you can have them moving together forward into the digital economy space, which is coming anyway, so we better be part of it now than waiting and jumping in later. You have USD stablecoins, which are 99%, so there's a lot of room for improvement for the Euro stablecoins, and that's where we want to take our place also in Europe as European banks and not leaving it, to the non-European players.
Yeah, well, I mean, it's a very interesting point about the tokenization and having an on-chain asset. But I want to come back to something that you said at the start there about tokenized deposits. If they were to go interbank, you would need a settlement layer. We probably will have something from the ECB soon. There's Project Pontes, but this idea of kind of unbundling money creation from the payment instrument, commercial bank money, tokenized deposits, and stablecoins being slightly different economic instruments. One of the qualities that, returning to the theme, one of the qualities of global reserve assets is typically they're yield bearing, right? Like if it's money market funds or government bonds or deposits at the Fed, anything that we would put in that category, typically they're going to bear yield. And yeah, maybe we can hear from a few of you on this idea of stablecoins bearing yield, or whether that should just be tokenized money market funds or tokenized deposits. But Matt, can you start off there? Obviously, we're in the context of a regulatory environment that doesn't allow yield-bearing stablecoins. But
yeah, I mean, to respond to the question, stablecoins are quite a poor reserve at the moment. They're quite a poor store of value at the moment, and that's because they typically don't pay any interest at all. So it's the digital equivalent of, holding cash under your bed. You can't earn a return on it compared to other assets in the economy. The reason for that, as many of us know, is that regulators around the world have restricted stablecoins, so they're not allowed to pay any interest. The reason why they do that is because they are concerned about the risk to the banking system. So they're concerned that if stablecoins were an attractive store of value, people would take their deposits out of the banking system and put them into stablecoins instead. And the risk there, as Dirk alluded to earlier, is that then you undermine the provision of credit to the economy. So there's a sort of a genuine macroeconomic fear that is behind that. I mean, I would tend to argue that those concerns are somewhat overblown. The idea that people would simply move their deposits into a stable coin. I would point out that you actually have significant channels that operate like that in the system today. So, you've got, for example, money market funds, which are fully backed, liquid claims in the same way that stablecoins are. You've also got e-money. You also have narrow banks, which are banks that back themselves fully with central bank reserves or highly liquid assets. So these sort of forms of money or quasi-money already exist in the financial system today. Stablecoins are economically quite similar, at least as compared as a store of value. So I don't see why stablecoins would pose a significantly greater threat than these sorts of claims that are already available out there in the market today. So I think this debate about whether stablecoins should be allowed to pay interest will keep rolling on. It's particularly lively in the US right now because the incumbent banking sector have been pushing back strongly against the idea that stablecoin holders will be able to earn any kind of yield, whether that's paid by the issuer or even paid by the intermediaries, where people might be able to sort of stake or lend their stablecoins. So yeah, this debate won't end anytime soon.
Nick, yeah, please, should hear from you on this as well.
I would go even a step farther in saying that, at least, and this is where I say that I'm representing my own views and not the views of Paxos specifically, at least within the US, I really view the prohibition against yield as purely driven by the banks. I think it is purely an attempt to protect themselves from what they view as encroachment from the stablecoin market. And so you see the result of them not quite getting their way in the language as drafted and passed it in Genius. We will likely have litigation in the United States as a result. I think you will all see in the coming months a lot of very angry letters from banking trade orgs. You've already seen a bunch already. I think you will see litigation. Because the reality is right now in the United States, the way it works in practice, and though Genius isn't in effect yet, is that issuers cannot pay yield. That's the prohibition under Genius. But Genius does not speak to distributors making payments, reward payments, marketing payments, and so functionally, you see a lot of the accrued value from stablecoins passing on to token holders while maintaining compliance with the strict reading of Genius. And, again, my personal view is that makes a lot of sense. Stablecoins, if you are just holding the stablecoin and not receiving any form of the economics of it, is you're giving a dollar to someone else and you are losing all the economic benefits of holding an actual dollar. If you do not receive any of that interest generated from the actual token, then you are just giving someone a dollar, and that's not the system that I think is effective for global economics. I don't think that's an equitable system. I think that's a system that really just enriches, a handful of players and allows certain companies to have more revenue per employee than any other companies in the world, and doesn't actually benefit sort of what I view as the ultimate goal of widespread adoption of stablecoin, which is a equitable and valuable payment system.
Yeah, I think there's a lot to that. But I should give Dirk a chance to respond from the bank perspective and talk about. Dirk, I don't want to put words in your mouth here, but you were talking about tokenized deposits versus stablecoins, and I got the impression that if there were an interbank settlement solution on chain, then you would rather do a tokenized deposit, but you are doing a stable. Can you talk a little bit about how you see the relative impact of those instruments?
Yeah, I don't. Depends what the usage is. Today, for tokenized deposits, there's a debate because you have tokenized deposit and deposit tokens, and stablecoins are a bearer instrument, so that will be something different already. And the banking system works fairly well for the economy. If you have the outflow to yield-bearing stablecoins, and is the question, what will happen if there is not enough credit to the economy? And what you could also look at it from a different perspective from the user. If you put your money in a bank, you get a return for it, but the return from it is actually part of and you can have a lot of debate on this, but it's part of the revenue that the bank gets from giving a credit, giving it back to the customer. So there is some revenue sharing that we do, because we put the money to work. We put the deposits to work in the form of a credit. If you will start giving yield on a stable coin, for what for doing the payment, for holding the money, because a stablecoin is the same as holding cash.
Well, in a sense, they're lending it to the government. Like if they buy government bonds and so on, that's a little bit like what banks do, except there's only one borrower, and it's the government.
There you have the difference in the backing then of the stablecoins, which is different in the US than in Europe, because in Europe it should be 30 to 60% in bank deposits because of the reason to giving credits. So maybe US Treasury, I'm also speaking in my name, by the way, if the US government wants to start giving credits when everybody is into stablecoins, it's funding the debt of the United States. And if they start giving credits, then you indeed don't need the banks anymore. But I thought that the US was more a liberal one, giving the free market the way to operate. So if stablecoin holders, issuers start giving credits and they get a credit license and they are regulated like a bank, it is what you do is regulated, not who you are. So if you start giving credits, then fine, that's also a possibility. But we can have a lot of debate on that. I think it's, you cannot, if you see what the calculations have been by ECB for the digital euro, which is actually the same money, funds flowing out of the bank accounts towards the ECB to issue digital euro, there are holding limits defined specifically for that reason, that banks can still fuel the economy with credit. So I think that's, if you cannot prove with another system that you can keep the economy alive, then I think you should be careful.
Yeah. Yeah, no, I think it's a really interesting debate, and just one more question on the yield question, and Nick, I'll pick on you for this one if you don't mind. To play devil's advocate against the idea of yield-bearing stablecoins, if we're dealing with a payment instrument and you want to pay, I'm a merchant and I want to sell you something, and you're holding your own stablecoin, and somebody else is holding a stablecoin that's remunerated differently, I, as a merchant, might prefer to receive the one that is remunerated more generously. Do you feel like there's any risk of market inefficiencies arising because people are preferentially choosing a payment instrument that has a higher remuneration? Which obviously, with bank money, although bank money is remunerated, I don't really receive the bank, the bank money because it's not a bearer asset.
Yeah, that's certainly something I could see being a short-term risk as we see wider stablecoin adoption. I think the reality is that if you look at the reserve requirements under the operative regulatory regimes that we see coming into place, whether it is MiCA, whether it is Genius, whether it is the stablecoin structure under Singapore, or any of the new pending stablecoin regimes, there's only so much difference in terms of the economics based on the reserve composition. And so I think the reality is once you see larger scale stablecoin adoption and once you see it become more regularly part of merchant payment flows, all those stablecoin economics will end up looking very, very similar because there's only so much delta you can have between the actual generation of them under the regulatory requirements. And so you would just very quickly see a race to the bottom for the issuers, the top for the holders, and I think that would sort of resolve that problem pretty quickly.
Quite a narrow band, yeah. And I suppose as I say that, it occurs to me that merchants are already dealing with a situation where it costs them different amounts of money to receive different types of payment, right? Whether that's
Correct.
Apple Pay or whatever. Excellent. Okay, well, I think there's lots to say on the yield topic, but we can move on for the moment to the policy environment. Catarina, I wonder if I can come to you to talk about that. You alluded already to, it's such a great instrument, and yet adoption still pretty small proportion of payments. And you shared in the prep call some thoughts about some of the policy-based obstacles to broader adoption.
Thank you for that. So the policy environment is obviously key. And the EU here was a pioneer in setting up a comprehensive regulatory framework for digital assets, including stablecoins. We've heard throughout the day how influential this framework has been globally for setting the pace. But a parallel fact is that we are a union of 27 members with several institutions, all with very different views and appetites when it comes to digital assets. This is a feature, not a bug, but it means that it's harder for the EU to have a very strong, unified vision and strategy for digital assets that we can communicate to the world. So we do have one law or one regulation in this case, but having one vision and one very clear strategy is sometimes as important when it comes to attracting business and fostering a thriving ecosystem for the industry. And I think a very good example of that is of those dynamics is the debate around the multi-issuance stablecoins. I have colleagues on stage that can speak about it with the right amount of passion and skin in the game. But one that is also close to heart is, and we've heard a lot of complaints about the travel which is prescribed by the transfer of funds regulation, so I'm going to give you another reason to complain about the transfer of funds regulation, and it's the fact that under the transfer of funds regulation, an amendment was introduced to the MLD, which is also present in the text of the AMLR, which essentially deems relationships for the purposes of for carrying out crypto transfers as equivalent to correspondent banking relationships. And now if we go back to the key advantage that I was highlighting before of stablecoins removing the need for payments to flow across correspondent banking relationships, which makes everything more complex and costly. So we have that on one hand, stablecoins remove the need for correspondent banking relationships, and on the other hand, we have the regulatory framework saying actually transacting in crypto assets is equivalent to having a correspondent banking relationship, so please abide by the same standards. I think this is not only disproportionate, the fact that you're having a correspondent banking relationship is a very different beast from facilitating a transaction with a cross-border institution. The FATF made that very clear in their guidelines, so they recognize that for transacting cross-borders in crypto, you don't need a correspondent bank, and so they made sure to clarify that the counterparty due diligence obligations that do apply under Recommendation 16 are different from those that apply under the correspondent banking relationship framework. The EU went in a different direction, which I think is not only disproportionate, but also really misses the point that with stablecoins we can live without this complex web of relationships that make payments more opaque and actually go against the goals that the TFR is looking to achieve itself. So it's kind of a contradiction that is missed.
Yeah, that's very. Can you talk a little bit more operationally? What does that mean to have to treat it as a correspondent banking relationship? What are the same sort of standards that you're talking about?
It means super heavy requirements when it comes to due diligence obligations. So there's obviously under Recommendation 16, for the purposes of transacting and sharing travel information, you obviously need to do counterparty due diligence, but it's a level of due diligence that is different from the level of due diligence you need to apply when you establish a correspondent banking relationship. And why I say it's disproportionate is that if you apply these super heavy rules on the due diligence you carry out with every international counterpart that you transact with, which in crypto it's many for most CASPs operating, then the system doesn't really make sense.
Yeah, no, absolutely. Wow, different mic sounds very different. I wonder if I can, actually I'll probably come to all of you on this idea of the policy environment and what you see as obstacles. So I guess if I just work down the line, Nick, if you want to go next.
Sure, so multi-jurisdictional issuance is like the biggest policy issue that's on my mind every day when I go into work. The only way to have a functional, global, fungible, and regulated stablecoin is to have multi-jurisdictional issuance. It felt like 10 or 12 months ago, more people were on that page, and now we are seeing a larger divide, and that, for me, is very worrisome. You know, my biggest fear is that multi-jurisdictional issuance stalls out, and that means that unregulated stablecoin issuance remains the primary form of stablecoin issuance, and that will just really hinder the growth of stablecoin adoption, especially stablecoin adoption by what we would consider more TradFi players, where I think that is sort of the next step that will really jettison stablecoin growth into becoming something that is global and real and builds the momentum to allow stablecoins to sort of fulfill what I view as the ultimate goal of them as a financial tool. And so I don't have any super smart ideas on how to fix that problem, but it's a problem. I think it's only going to become more of a problem as we see more regimes adopt their own regulatory infrastructure, and we see how they deal with things like reciprocity and allowing issuance in domestic jurisdictions without requiring actual domestic issuance. And I will say, as someone who is outside of the EU looking in, I do have concerns about the direction that the EU is going in particular, because, you know, MiCA is great and was a really forward-looking piece of regulation, but if the rest of the world adopts global stablecoin issuance models that permit for either multi-jurisdictional issuance or more viable reciprocity agreements, then the EU is going to be stuck in a very difficult position.
Yeah, I think Peter's gone, so you don't have to say MiCA's great anymore. No, but I think, I think this multi-jurisdiction issuance is a hugely important point and is going to be kind of the crux of the extent to which stablecoins can function in the way we're talking about as a global settlement instrument. And I think whenever anyone talks about the use cases, I think it was the first thing you mentioned, Dirk, it was about cross-border, right? And if that was only within a block, it's going to really limit the potential value of the instrument. Matt, do you have anything to add on that?
Yeah, I mean, I think stablecoins add a lot less value from a domestic payment point of view. I mean, we already have very fast, very cheap, faster payment systems or card networks for domestic payments. It's not quite clear how or why stablecoins would break into that market. You know, the real value, as we've heard on this panel and multiple times today, is for cross-border payments, because stablecoins can move value anywhere in the world in seconds. And that's an amazing thing when you consider the delta versus the system that we have today. But to be able to do that, as Nick said, you know, you do need to be able to use the same globally fungible stablecoin across the world. Otherwise, how can you transfer value across borders? So if if a jurisdiction like the EU forces stablecoins to only be local, that essentially breaks the main use case for stablecoins. I think it's really an example of sort of, the EU sort of harming itself by cutting off this potential source of growth. There are also consequences for Euro stablecoins. I mean, I think some of the Euro stablecoin issuers would love to be able to issue their own stablecoins globally and have those stablecoins accepted in the US or other jurisdictions around the world. Well, you know, if the EU essentially shuts its borders to global stablecoins, that simply won't be possible, because other jurisdictions would take a similar approach. I mean, we do appreciate the concerns that central banks have about this. I think the ECB and the ESRB have got some legitimate concerns about the risks involved in multi-issuance. But I think we believe that those risks can be mitigated. You know, there are robust safeguards that regulators can put into place to mitigate those, that actually draw on some of the existing models we've got for cross-border provision of financial services, such as banks operating cross-border. You know, you can have things like, under MiCA, you can have local reserves which are required to be held within the EU to protect the EU users. You can have cooperation arrangements with the overseas regulator. You can have restrictions on the redemption rights for EU users. You can have a wind-down plan under MiCA, which can set out how exactly these redemption arrangements would work in stress. So, you know, we believe that there are already really robust safeguards that NCAs can use to mitigate these risks. And, you know, we just need a solution quickly.
Yeah, absolutely. But I think it's going to be a question of whatever set of rules you select, there's going to have to be some global acceptance of that, right? It's very difficult to do this unilaterally. And even something like redemption periods. I think a big part of the EU's concern is that if they mandate a faster redemption of stablecoins than, say, the US, then there's a sort of fear of a sort of redemption tourism. People come over and redeem there, although I think it's actually quite a lot harder than that. You have to have like a local account, etc.
Yeah, I will say the reserve requirements under MiCA, I think, will kill any desire for redemption tourism.
Well, I was going to come on to Dirk and ask about reserve policy, or I guess anything in the policy environment that you have beef with.
Well, being compliant with MiCA, of course. So you have to look at the bank deposits, 30% minimum or 60% when you're systemic. And the others, high quality liquid assets need to be in place. So that will be the first basis to start from. Different from the US, of course, where they have other mechanisms or more possibilities to do the reserve management. So we'll have to see how we will do that. Might be maybe easier to be more flexible in the beginning, have some transition period, but we will have to follow the rules as they are. And as for banks, what will we do with the reserves? You read in the paper, they will be at banks, but at banks they also have to be highly liquid because redemption can be at any moment. So that we are there as trustworthy parties behind the stablecoin. We're part of the board of Kivalis, so we will have to monitor that they're doing it in an appropriate way. So we want to bring that way the trust also in the market, that when you have this stablecoin, you can trust that it's always €1.
Yeah. Can I ask on with the consortium stablecoin, with most stablecoins you can't as a stablecoin holder you can't just go and redeem it, right? You've got to have a relationship with the stablecoin issuer and be doing a certain amount. With the stablecoin consortium, if you're a bank customer and you end up with it, can you convert this into bank money? How does the conversion into commercial bank, into regular deposits work? And
you have to look at it as everything that is today in place with MiCA and the CASPs, the crypto asset service providers. So the consortium is issuing the stablecoin, and then it is the CASP, the one who is doing the custody or having the transfer licenses, who is delivering the service towards the customer. So that's also the first point of contact for the customer, is the CASP or the bank or an exchange to be able to exchange the stablecoin into fiat money, and then it's up to the exchange or the bank to go to the consortium issuer to redeem it into euros. So there is an indirect, it's a two-layer.
So quite a traditional stablecoin rather than a traditional bank model, right? You're dealing with it through the CASP. Yeah. Okay. Thank you. I realize have been asking the audience if they wanted to ask any questions, so I'll do that now. If there are any questions, stick a hand up. We can send a mic around. If not, I will. Yeah, we do. Please. There's one down on this side. Mic on the way.
Hey, thank you very much for the panel. It's a very interesting debate. I just wondered if you had some insights regarding financial stability and stablecoin issuance, because obviously the mode of emission is completely different from how you emit money under a debt-based monetary system, which normally isn't about intermediating money, but really about monetary creation. There's a creation and destruction cycle. When you make a credit, you create money, and then when the money is repaid, it is destroyed. So how does that affect that kind of system with the stablecoin issuance? Thanks.
So if I repeat the question, because I didn't hear it quite well, how we look at financial stability if there is...
If you add stablecoins to the picture, which have a different mode of emission than debt money.
Yeah. The monitoring of it depends on how much euros are converted into stablecoins. Yeah, so it's to have an impact at the bank money creation that banks are doing. So if you, the value which is created into credits of bank stablecoins is still a small portion of that, because it's only for a payment means. So there is no direct impact on the financial stability in that way. So that's something that might happen if there is a lot of money into stablecoins, but for the foreseeable future, that is still manageable.
Anything else to add on the, yeah, please, financial stability?
Yeah, I think I'll add just on this point about the risk of stablecoins, but it's true that stablecoins could potentially suffer from runs in the same way that banks do. You know, if all of the users of a stablecoin sought to redeem them at the same time, you know, the stablecoin issuer is probably going to struggle to meet all those redemption requests, you know, in the normal time frame. But I would say, you know, there are increasing efforts to differentiate stablecoins. So you have regulatory regimes emerging around the world which make stablecoins much safer, including here in the EU. And also, you have stablecoin issuers that are seeking to differentiate themselves on the basis of the safety of their stablecoins as well, which is a phenomenon we have seen in the last few years. And if a stablecoin is safely backed like that, fully backed, or even more than fully backed with highly liquid assets, then a claim on a stablecoin is potentially a lot safer than a claim on a bank that actually is fractionally backed. So is lending part of those funds out into the real economy and has a maturity mismatch between its liabilities and its assets. So in principle, at least, a stablecoin can be safer than a bank deposit.
Yeah, I think it's an interesting one to think about. You know, if you're talking about financial stability and stablecoins, what would the source of the threat to financial stability be? And it could be the run on the stablecoin. It could be runs on banks. Although I guess, you know, you've got a question of whether that's acute or chronic. Like if a bank is in trouble, stablecoins being a new destination might exacerbate that. Although, as Matt pointed out, there are already other vehicles that people can go to. And then there's the more chronic issue of would it just sort of slowly suck away deposits? And would that be a problem? Could banks still create money without that deposit base? Maybe they sell a few more bonds. It could work if you kind of unbundle that. So I don't know if that has answered your question enough to talk about the potential ways in which stablecoins might change financial stability. But it's not always from the stablecoins themselves, I guess, is the thought. Anything to add, Catarina? No, you were just like, yeah. I think, do we have any final thoughts from the panel, or should we wind up there? I think.
Nothing else?
Terrific. Well, I think everyone is more than ready for some networking drinks. So thank you all for staying. It's been great to have my panel, so let's give them a round of applause. Thank you.